conversations like that is really non-traditional. It fits certain situations, right? It has to be right for every individual because every individual situation is unique. So we have the power to have a conversation around, again, a product that's been non-traditional. And if you think about it, typically when the government regulates how much money you can put into a certain vehicle, that typically means it's pretty good for the consumer, right? Think about IRAs, think about 401ks, think about life insurance, right? The government regulates how much money you can put into it. Typically, that means it's pretty good. So it's something to explore as part of your overall wealth creation strategy. And it's a powerful vehicle once you really understand it, because it's not promoted, if you will, in the market, on the news, through speakers like Susie Orman and David Ramsey. David Ramsey's a big buy term and invest the difference person, which I get.
The problem with that is we don't invest the difference.
Right, you got it. 9 times out of 10, when my partner Jordan and I are sitting down with clients, it's Jordan, everybody, and we're talking buy term and invest the difference. When we come back a year after the term insurance was purchased, so we put the protection in place and we start to talk about, hey, did you invest the money that we discussed into XYZ portfolio? Well, no, we didn't do that yet. Right, so we have to be proactive in making sure that we're keeping track of what's going on. It's not a strategy where once you purchase a product or service, you're never going to see us again, because a permanent life insurance policy needs review every year to make sure that it's doing what it's supposed to be doing. And if it's not, we need to make some changes. All right, so I'm glad to be here. Greg, thanks for having me.
So you guys, most of you guys know me as a real estate investor, and most of you guys are investors. And so as real estate investors, we're always looking for better ways to finance our investments. And so whether we're flipping properties or buying and holding properties, we need financing. We often look for private lenders. Most of you guys have heard the term hard money lenders. And then there's private lenders as well. And so what we're going to talk about today is a term called infinite banking that will allow you to basically be your own private lender so that you can help finance your own investment properties. And so I always like to tell the story about my daughter, she's now 24. She'll be 25 years old in May. And so I took out universal life policy when I think she was about 12 or 13 years old. Index IUL, index universal life policy. And the reason I did it was because I wanted to make sure that I wasn't too confident when she was about 12 or 13 that she was going to do anything in life. And so I wanted to make sure she did, but I didn't want to make sure.
She was doing stuff at 12, 13.
All right. She was in school.
She was in dancing.
Yes, she was. But anyway, so I took out an IUL for her. Now, I was the custodian over it, but I took out the IUL for her primarily for retirement. And the agent that I spoke to said that you only have to make payments on this policy for X amount of years, and then she can either take over, or after X amount of years, there's no more payments. And that was attractive to me. Fast forward to now, she graduated from college about 2 years ago. She bought a house to live in last year. And so I went to her and I said, Beverly, now it's time for us to start thinking about an investment property. And she said, well, Daddy, I've got my house, I'm good. I don't have the money to buy an investment property. And I said, well, Beverly, your only job in life, your only job is to keep your credit clean, because you have this IUL with cash value in it that we can pull out tax-free and use that. She only has about $40,000 in it now, but you can use that as your down payment, your closing cost. You could be your own private lender and then use maybe a hard money lender for the acquisition of the property. And then once you buy the property, renovate the property, and I'll talk more about this later, renovate the property, you refinance to permanent financing, you pay your policy back and it keeps growing. And so that policy for her really is the gift that keeps on giving. It keeps growing, it's compounding. She can pull the money out tax-free. And so when I explained it to her, she said, find me a property, I'm ready. And so that's really what we're going to talk about. And so what I just described really is what infinite banking is all about. And so Phil, why don't you just kind of in your own words describe what infinite banking is?
Oh, well, thanks, Greg. I mean, if you think about the bank world, right? I mean, what do they typically do with your money once you make a deposit? Right? They invest, right? They loan it out. They give us 1%, right? And they charge somebody else 4.5% interest on your money. Right? So think about this strategy as a way to be your own lending institution, be your own bank, control your own dollars. Because of the way that the insurance policies are structured, it's not a short-term, I put X amount in, I can pull money out immediately. There has to be some time. You need to give the life insurance policy to accumulate some cash value. There is underwriting so that you do have to qualify for it, right? Because it is life insurance, right? But once you start making contributions, you're putting the money to work for you, not putting money into a bank or another investment where they may lend it out somewhere else. But the benefits of this really are around the taxes. Because as your policy is accumulating cash value, it's growing on a tax deferred basis, right? Versus putting money into a traditional investment like a mutual fund, where if you have gains inside of that mutual fund, you're going to have to pay taxes every single year. So you're really deferring those taxes, which also adds to the growth inside of the cash value. And as Greg alluded to, your ability to pull the money out tax-free in the form of a policy loan to yourself that eventually you're going to pay back and use it for either subsequent real estate transactions or retirement income,
College fund.
or like I did, because I have 3 children. I took 3, they're variable universal life policies out, but a long time ago, and now I'm starting to use those for college education planning that eventually I'm going to pay back and I'm going to use for retirement income at a certain point. I don't have to go to my insurance policies, there's no credit checks. I don't have to go through all the paperwork necessary to take my money out. And I'm able to use it, again, in the form of a policy loan that I'm not paying taxes on. Because the money that's inside your cash value, it stays inside of the policy when you loan it to yourself. Because you're taking a loan from the insurance company. So the money, the cash value inside of that policy continues to earn interest. Right? And as you pay that money back, you compound that interest even on top of what you're currently earning. A lot of these strategies, again, are on an individual basis, but they really work depending on how you fund them. How you fund and how much in contributions you're willing to make. Because remember, it is insurance, there are fees and expenses inside of it. But the way we sit down and help people, individuals, structure these allows the policy, allows the cash value to grow, where we don't run into any, we try not to run into any issues. Okay, so funding these.
Right, and so I think
is very important.
that's the key. And so we're talking about cash value policies, you guys. We're talking about whole life policies. We're talking about universal life policies. You're going to be making monthly payments. We call them premium payments. Now, just like a mortgage, in a mortgage, when you make your mortgage payment, first 5 years, the majority of your payment goes to what? Interest, right? And then part of that goes towards the principal. When you're making your payments on your life insurance policy, initially, a lot of that payment goes towards the death benefit, and then the rest goes to your cash value. And so, but over time, more of that payment goes to your cash value. And so, as I said earlier, this is not a get-rich-quick scheme. It's the sooner you get in, the faster that money starts to grow for you, and it's compounding in the policy. Now, I would want you guys to get a policy, sit down with one of the agents, let them do an illustration for you. And the only way, if you guys are taking notes, write this down. The only way these policies work is if you overfund the policy. So write that word down, overfund. Meaning, my payment is $200 a month. I pay sometimes $300, $350 because I want to overfund it. I put more money into that account. Why? Somebody tell me why.
So it increased cash.
So that cash value, I'm putting more money in, and then the interest is compounding, and it's growing. And so we want to overfund our cash value. So is it better to put more money into our insurance policy or put that money into the bank? It's insurance policy, because insurance policy, you could be getting 6 to 8%. And you're protected. I'll have Phil talk about this in a second, but you're protected against any market fluctuations. You're never going to lose. They require, not require, but they, what's the word I'm looking for? You know the word I'm looking for. Read my mind.
I'm trying.
They guarantee you no losses in your insurance policy, okay? So we want to overfund. We want to pay more up to a certain limit. There's only a certain amount that you can overfund. When you overfund, it's called a MET. We won't get into that. But we want to overfund. So Phil, explain that, overfunding a policy.
Yeah.
And the importance of it.
Yeah, it's huge. I mean, the significance of that can't be understated. And we've seen that on existing policies that were sold back in the late 80s, early 90s, where a lot of agents were out just having their clients fund either the minimum or at what they call a target level, right? And interest rates and market fluctuations are gonna dictate the cash value growth. So what we've been doing a lot of, not so much recently, but certainly 5-10 years ago, trying to save these policies for these clients. And they get letters from the insurance company saying, in order to keep this existing policy in force, you have to make a $10,000, $15,000 contribution because they weren't funded correctly because of interest rate fluctuations. Think about the environment over the last 15 years. Think about today, right? The Fed's probably going to raise interest rates again to help combat inflation, right? We're not out of the woods yet, unfortunately. So how's that going to impact these interest rate sensitive insurance contracts? It all comes down to making sure that when you sit down and you run the illustration and you look at the benefits of overfunding, hypothetically, what it could do to the cash value of your contract versus having 10, 15 years down the road, not enough cash value in your contract because it wasn't funded correctly. And making sure there are adequate funds that you have to be able to continue to overfund, but know that there is some flexibility with these types of policies as well. That if you run into an issue and it is properly funded, then you'll be okay. If you run into a financial situation like COVID happened, we were fortunately not having to go back and ask clients to continue to fund their contracts at a higher level because they were properly funding them, right? COVID hit a lot of people hard. And unfortunately, we lost some clients, but we kept most of them because of the way the policies were funded. And we didn't have to go back and ask them for more money when they didn't have it or when they were going through some financial hardships. So making sure that they're funded up to that annual limit, or it's really in between the target premium or the annual limit. The target premium is the number that the insurance company basically says, in order for this policy to do this, you have to contribute that, right? You put in the annual number and it's going to do this. So you have some flexibility, right? You have some options that you can look at and say, all right, I'm going to do like Greg did. His target premium is $200 a month in order to keep the policy in force. He's overfunding it up to a certain limit so he can have more of that money go into the cash value and provide more capital for his daughter to be able to do the real estate transactions, for your children and grandchildren to be able to supplement college costs, for us to be able to have tax-free income at retirement at some point. So funding the policy plays very heavily into the recommendations that we make and how we move these policies forward.
Go ahead, Dana.
What would you say the age cutoff to where this is not even going to be effective for you?
That's a great question. Obviously, the younger the better, right? Obviously, the younger the better.
And when we say the younger the better, there's $1 million baby policies when some people have children 1, 2, 3, 4 years old, they take out the policies to give that policy more years to accumulate cash and compound. So for though we have grandparents that take out these types of policies, but someone, let's say, is 60 years old or older or mid-50s. What are some of the options for them?
They would have options for sure. You'd really have to look at the cash flow position at that point and the health, right? Because we do a lot of insurance policies, right, Jordan, for individuals that are 55, 60, 65, that dependent upon their rating are able to move forward with the insurance because the financial position that they have, once we do the analysis, can sustain the policy, right? So the health plays a lot into it too, because you have to get underwritten for the insurance, right? And we're living longer today with advancements in medicine, advancements in medical technology. There were things that used to be a decline for life insurance that are now not anymore because of the way the medical community has been able to handle them, right? But look, in a perfect world, if you really want these to run correctly, you could take them out on your children, take them out on your grandchildren. But it would be us sitting down and making sure it's the right thing for you to do based on your age, based on what you're looking to do it for. Looking at your health is also very important. We're not just going to make a recommendation and move forward with it if we know that we're going to run into some issues because we're going to ask some health questions, right? But it really depends one-on-one when we sit down with individuals that are 55, 60, and 60 plus, because we have done this before, whether or not it makes sense for them to contribute X amount to this type of strategy.
So my recommendation would be to sit down with a strategist, set an appointment. You guys can fill out the green form. Or where's Stephanie? Is Stephanie still here? Or make an appointment with Stephanie. She'll be right back. But hold up that form. Just fill out that form. If you guys want to sit down with these guys, we have some other big life agents. Yeah, Donald's in here. You see the shiny head in the back?
I saw that.
The shiny one. And let them do a free illustration. Some of you guys have policies now. Let them do a policy review. Make sure you have the right type of policy. I wasn't afforded that. When I bought a policy at 30 years old, that term policy, I never heard from my agent again. And I wish I had, but I didn't. But there's, but since then, there's just a bunch of different types of policies. You asked about a term policy. In some cases, term is good. Just you got to make sure that you get a term policy that you can convert into a permanent policy. And then make sure that you have an agent that's checking on you every quarter, every 6 months to let you know when's the right time to convert it. Because you can, let's say you can't afford a whole life policy now, you can get a term policy now. Now you've got coverage. Anything happens to you, your loved ones, they don't have to worry about funeral expenses. They don't have to worry about setting up a GoFundMe page. But then, when you have the wherewithal to convert that into a whole life policy to pay more to start building cash value, you can do that. And so that's one thing that I would recommend. Valerie, did you have a question?
I did. I think I have two questions. The first question is it possible to give an example of, say, someone who's 55, what would be an ideal scenario, what would be a monthly, and what they could look forward to, and how long before you can actually see, substantial returns? And then my second.
Well, let me answer that, and I don't know if Phil wants to answer, but I think that there's so many variables that go into play. Age is one, like you just said, your medical condition, your own personal finances. So there's a lot that goes into play. So it's kind of difficult to give you that kind of scenario unless you have one.
No, I think you're right, Greg. It really, we're not going to move forward with a strategy like this if we're talking to someone who has a lot of debt, right? And doesn't have the right cash flow and has more month at the end of the month, right? Because it's not going to make sense. We're not going to strap somebody that way. So the financial analysis that we do is extremely important, because if it makes sense and you have, we'll call it disposable income at the end of the month to be able to put towards a strategy like this, then it makes sense. Then we'll look at, okay, the death benefit amount, right? How much insurance? And then we'll look at the health. And then we'll run an illustration that says, okay, if you do this in 10 years, hypothetically, the cash value will look like that. So there are a lot of variables that go into play, and it really depends on the individual that we're sitting across from at that time.
Okay, then second question, it sounds like we're talking long-term, you mentioned 10 years, but somehow this plays into investing currently, or?
Well, it does, in that you've got to build up cash value in your policy. And as I said earlier, you're not going to build that up overnight. You're not going to get a policy, qualify for a policy today and be able to use that money tomorrow. And so it's got to build up. It's like almost like, it's not a stock, but it's almost like that, where it sits in the account and it compounds. It builds up. So that's why I said I gave this the scenario with my daughter, who's now 24 years old. She's got about $40,000 in her account, but that happened over a period of time. And then you can accelerate that if you put more money into that by overfunding the account to a certain limit. And so that's why you got to really sit down with these guys and let them do an illustration. Because if you put too much money in, then you get taxed on that money. So you've got to let them tell you how much to overfund the account. But like Valerie said, I think this really does relate to real estate investing. What I would want for you guys is to build up a portfolio of real estate. All of you guys want to retire financially free. All of you guys want to leave a legacy, build generational wealth, all those types of things. And so utilizing your insurance policy, which you should have a policy anyway. Less than 50% of all Americans have an insurance policy. And so you don't want to be a burden on your loved ones if something was to happen to you. But not only that, you want to make sure that if you have a critical, chronic, or terminal illness, that you're covered. And all the policies that we sell are covered. Those are called living benefits. So you're covered if something was to happen to you while you're still living. And you can utilize the money while you're still living. But you want to build that money up as one way to use for real estate investing. And so when we talk about real estate investing, we're talking about using that money to buy and hold real estate, build passive income, not active income. We're not using this we could use this to flip properties, but I would want you to, flipping properties is active income. You flip a property and you just get paid that one time. We want to use that money in that account as one option or one strategy amongst other real estate investment strategies to acquire properties that are growing passively, giving you cash flow passively through residential properties, multifamily properties, Airbnb. Some of you guys are interested in assisted living facilities. You borrow the money from yourself tax-free, so it's not a taxable event. You build it up and then you pay it back. But here's the beauty of it. I told you guys that my daughter's got about 40,000. She can borrow. Let's say she borrows 30,000. So now she's got $10,000 left in her account. The beauty of insurance is she's still compounding at the 40,000. At the 40,000, even though she took out 30. That's kind of like stealing money, isn't it, Susan?
What kind of insurance was it that you got for her when she was young?
It was an index universal life policy, an IUL.
That's what I needed.
Yeah, and so I would recommend the younger, like I think I mentioned earlier, children, your grandchildren, and we're talking about this as it relates to real estate investing, but it could be the money, it's your money. You can borrow your money tax-free. A lot of people use it for college or whatever, but you get it, the younger, the better. My daughter, for the rest of her life, she doesn't have to worry about buying insurance unless she wants another policy that's going to build even more wealth for her. But since I got that for her when she was young, it was the second policy, she never ever has to worry. Like I have to worry because, I had a medical issue, surgery. She never, even if she has that, so she's got that permanent forever.
Okay, so I'm hearing tax-free, but how about interest? Are you borrowing at an interest rate?
Yeah. Well, go ahead, Phil.
Yeah, you are. And the way the policy loan works, you're typically borrowing at like 4% interest, right? But if you think about what Greg just said, it's 4% interest, but your money stays invested. So if it's in a whole life contract and that whole life contract is guaranteeing 3.5%, right, then your interest payment technically is 0.5%. And the interest is something that we have flexibility with. Because typically when you take out a loan, let's say we go to take out a loan from a bank today for a real estate transaction or college or whatever. When do you get a bill typically in the mail? When you got to start making payments on that loan.
Right away.
Right away, with 30 days later, right? I take a loan from my life insurance contract. I pay it back when I can pay it back. I determine the payback terms, right? Not the insurance company. I determine it. So I have a little bit of flexibility there. So I don't have to make that interest payment within 30 days because I'm still continuing to put money into the policy. I'm still contributing to the life insurance, but I don't have the pressure of having to pay interest back immediately.
Or
What,
Jack, go ahead.
I was just gonna ask, what do you mean by that? Because if you have to pay interest on it, based off of the amount that you take, they just add that amount onto it as a fee? Okay.
The interest continues to compound inside of the contract, right? But let's say after a year, my interest is $500. I pay the $500 after a year. right? Or after 2 years, I don't want to make any interest payments and it's $1,000 and I'm ready to make an interest payment back into the policy. I make it then, right? And you see that in the illustrations that are run, right? It shows what the loan value is. It shows the interest and how it grows. And you have the flexibility to be able to do and determine when you start to make those interest contributions.
I think we could take it a step further too. What if something happens to you while you have a loan out there? What do they do? In the banking world, what do they do if you have a loan out there and you pass away? Your family takes on that loan. But if you have a life insurance policy with cash value and you take out a loan, it comes out of your death benefit. So if you have a $10,000 loan out there, $500,000 policy, your family's still getting $490. That's a big difference.
So you can borrow money from yourself, tax-free. You don't necessarily even have to pay yourself back as long as you've got enough death benefit in the policy.
This is something I always wonder. I don't know if you have answered already, but how easy is it to access the funds in the policy? Like how soon can you pull money from the policy?
And so that's the beauty of the cash value. Did everybody hear his question? And so in an insurance policy, that cash value is liquid. And so let's say I have $100,000 in cash value and I've got $100,000 in equity in the property. If I want to get to that equity in the property, I would either have to refinance, which is going to take 30 days, or I'd have to sell the property. In insurance policy, it's liquid. You get your money right away.
Yeah, and we have the capability of doing that right from our phone.
So you get your money right away after you build the cash value.
Yeah. This is not a get rich
You can't
quick
get a
scheme.
$10,000 loan with no money in your contract. Good point. It'd be nice if we could, but
These guys want their money now.
right, not messing around.
Michelle?
So, you can let me know. So let's say I sit down with you and you tell me the maximum I can overfund an account. The annual limit would be, let's say it's like 40,000, right? Okay. And I just pay that for the whole year. Okay? I overfund it.
Mhm.
But if I wanted to turn around and borrow some of that money, I could. Am I hearing you correctly?
Correct.
Okay.
If you have
so-
money, if there's cash value inside of that contract.
Right, exactly, within that correct. So, so if I'm an investor and each time I sell a house, I may say, look, I wanna get with you, I wanna pay this premium for the whole year and fund the account for the year.
Mhm.
And then if I want to, if I need to, whatever cash I can be able to pull out if I wanted to.
Right.
Okay, I just wanted to make sure I heard you.
And so sort of what that means is, you guys, especially if, like Dana, you've got grandchildren, right? You can take out a policy on them. It's their policy. You can be in charge of that policy. If you're of the age where it's going to take you a lot longer, you got medical issues, you got a grandson that's 19, 20, whatever, be their policy. But you control the policy. And you can take advantage through them of the cash value. Now, again, the younger, the better. The better the medical condition, the less your premium, your monthly payments are going to be. But you can do that. Susan, you've got 2 children. You can take out a policy now, be it whole life, universal life, for them now and let that pay for college.
You have to do one for each, right?
But the premiums will be low because they're so young.
Right. I'll be calling.
Vaughn, did you have a comment?
A question.
Keep it short, Vaughn.
What's the difference between the infinite bank concept with universal life and whole life?
Good question.
Yeah, it is a good question because they're 2 completely different types of life insurance policies, right? So they're gonna perform differently, right? A whole life policy, you have a guaranteed interest rate, right? So your guaranteed interest, our guaranteed interest rate on our whole life contracts now is 3.5%. So cash value is going to accumulate 3.5%. What's non-guaranteed in whole life are the dividends, right? The dividends are basically a return of premium that the insurance company
Right.
pays to their policyholders
Okay.
right, in the form of a dividend payment. The cost of the insurance, right, in whole life, it's set when the policy is issued and does not increase.
Right.
Okay?
Right.
Universal life still has a stated interest rate, but not necessarily guaranteed.
Right.
Okay, and that's where we ran into a lot of trouble with these old universal life contracts because interest rates fluctuate, and these
Right.
life insurance is very heavily tied to interest rates because of what the general accounts of the insurance companies invest in.
Right.
They invest in interest rate sensitive securities to make sure to provide these guarantees. So universal life has some premium flexibility though,
Right.
in that you can determine how you contribute to it. Whole life, it's set, right?
So in all actuality, you probably would need both of them.
Potentially, it could be a combination of both. Certain companies have more flexible whole life policies where you can overfund them
Right.
and
right.
use different dividend options,
Right, right.
right? So you're not strapped and set to this certain number. But again, the infinite banking concept works well with whole life, right? Because of the guarantees. It works well with a universal life or an index universal life because of the way you fund them.
Okay.
It can be a combination of the two, but again, you'll have to sit down and run the illustrations and go through the scenarios and present the options.
Right.
And then you choose which option makes the most sense, right? Our job is to educate.
Okay.
Right? Our job is to provide you with options based on your situation
Okay.
and then help determine which one makes the most sense. But to Greg's point, be there with you every year to make sure that it's still performing and doing what it's supposed to do. Right? And that's where a lot of these run into trouble. Right? Well, my person came out 3 years ago and I haven't talked to him since. Well, that's the reason why your policy is performing the way it is. Because if this would have been caught a year and a half ago and made some changes, it wouldn't be in the position, the insurance policy wouldn't be in the position that it's in today. Right? So really making sure you're keeping up. It's not a set it and forget it, right? It's not like you're investing in a stock and you're going to ride that stock all the way out. It has to be reviewed annually. It has to be talked about annually. Because why? We're human, we forget. Right? Well, remember I told you that a year ago? Well, no, it's been a year. How are we going to remember what we talked about a year ago? So making sure we're in front, we're upkeeping to maximize either or, either UL, IUL, or other way.
Donald?
Yeah, I just like to comment that, some people are sitting here saying, well, I got insurance already. But it's possible that you might not know everything that's in your policy. You do what's called a free policy review and help educate. A lot of times I sit down with clients and actually educate them on something that they might have purchased 5, 10 years ago and really didn't even know how it works. And so we educate you, show you how that policy works. And then now you're a little bit smarter, you can make more informed decisions, and we can show you some of the new stuff, especially the living benefits, because a lot of the old policies, they don't have living benefits. And
Yeah,
living
my
benefits
daughter's
is-
policy didn't have living benefits.
Right, right. And sometimes with these pricing, you actually can get a better, it can come out more beneficial for you to look at something newer opposed to what you had older, because of the living benefits.
And so Donald, talk to us a little bit about putting together either the millionaire baby policy or millionaire millennial policy and what that looks like for like millennials.
Yeah, so millennials, man, wow. I wish I was a millennial again. The cost of insurance is very low for millennials. You got your health. I like to say your health is your wealth. That's why anybody who's healthy now, you definitely want to lock in your insurance, no matter what your age is. But with millennials, we can design a policy for them. Same with, I call it the $1 million baby policy for little babies, grandbabies, or the $1 million millennial policy.
And we can design that policy for millennials where they can build up cash, they can use it for real estate investment, for college funding, business investments, and supplement their retirement. So if you have 20-year-olds, 17-year-olds, 18-year-olds, I got a brand new little grandbaby, you control those policies, by the way, too. So if you write that up, you can be the owner and control all the funds, what's going on in the policy.
Yeah, which is huge, because if I gave my 19-year-old son access to his cash value on life insurance policy, he'd be gone.
I got a lady in Texas, she's the grandmother. Every time she has a grandchild, she automatically opens up a new policy for those kids. So like, this might be $25, $50 a month. So now later on in life, when those kids need some money for college or whatever, she just goes to the policy. It's sort of like a be your own bank, So we can design those for you as well.
Dana?
So at what age does the youngster become when you lose control of that policy?
It's really up to you. It's really up to you.
Yeah, when our policies, there's no automatic switching at 26 or no, until you actually find that this person is responsible and you want to turn it over, you as the owner, you can do that.
I hand it over when I'm ready.
When you're ready.
There's a form that you fill out. But up until then, you can, take that money out tax-free and invest it, put it back. And so you're almost what I call kind of double dipping. And so your money is growing, it's growing tax-free, it's compounding. Now you're going to take that money out that has compounded, put it into a real estate investment that's building passive income, and that's growing as well. And then you're going to pay yourself back and keep doing that. So you're using this compounded interest to buy real estate investment that's really compounding, growing, appreciating, and you just keep doing that. And that's really how you build wealth. It's like the double play, you double dip it. And so that's really the purpose of being your own bank, infinite banking, and even family banking. You want to explain that a little bit? How can a family use these policies to build, value or funds for the family?
Yeah, that's a good question. But before I get to that, I think there was a question in the back too.
Now, I was just thinking, when my two boys were born, I purchased savings bonds every month. But just listening to Donald, it sounds like this is like the new thing to do now on a monthly basis, as opposed to savings bonds.
Yeah, because you're able to get more interest on your money, right, than just a general savings bond, and you get the protection, right?
And savings bond, there's no death benefit. There's no living benefits.
Right.
You get chronic, critical, terminal illnesses. You can't take out money, tax. I mean, it's just a lot better. And here's the secret. You said this is the new thing. This has been around.
Yeah.
I mean, we don't talk about it.
Yeah.
I think Phil said that earlier. It's been around as long as Vaughn used to sell that like 40 or 50 years ago.
Oh.
Look up, Vaughn.
It has been around. Nelson Nance was the one that first started it.
Yeah.
And so we just have to, we have to keep coming to these type of forums and educating ourselves. And so go ahead and explain the family, how can families get involved to build up cash?
I mean, you could do it in a couple different ways, right? And I'll just use my own family as an example, because not only do we look at life insurance as protection, but we look at life insurance as an asset class for us, right? So I have 3 children. All 3 of my children have their own life insurance policies that I took out when they were babies. And I've been funding those ever since to build wealth for them, to use it when they're ready for college, which is something that we're doing right now. Or if my youngest son, who's 10 years old, wants to start his own business when he turns 25, he has capital there. Right? So using children's policies on the children to accumulate wealth for them. And then for myself and my wife, I looked at ours as money that we have set aside to do things with, but also for retirement income. And we look at our insurance policies very similar to an IRA, right, that's on steroids, where we're able to put more money into a life insurance policy than we can either a Roth IRA or a traditional IRA to use for retirement income.
Your destination is on the right.
She's right, you're right there.
You're already at your
You're already
destination.
there. And we're able to pull that income out tax-free for the rest of our lives. And you're really able to create multi-generational wealth as well, that you can pass to your children, to your grandchildren, and leverage for your grandchildren's children. Also through the death benefit, because we do a lot of multi-generational planning. Because when you think about real estate, you think about the tax benefits of insurance. We want to make sure that we protect what families worked hard for. The children, the wives, the husbands, the spouses, the grandchildren, etc. So we want to keep that money for the family's benefit. We don't want it to go pay for unnecessary taxes or go to the government for whatever reason. So you have an opportunity to create multi-generational wealth, leveraging these insurance contracts, not the same way that we have, but I'm already looking at, my grandchildren at some point in time, if I'm so blessed, because the tax benefits that are affiliated with life insurance, not just on the cash value, but on the death benefit. So if I pass away, and I'm surprised my wife hasn't cut my brakes yet, she's going to get a couple $1 million completely tax-free. And that money's going to be to go to pay the mortgage, take care of any outstanding debts, put money into a side account, and the family's going to be able to take advantage of that because I've done some estate planning, so I've protected it for the rest of their lives. So insurance as a multi-generational product has a number of different uses to it, where you're able to create wealth for a family. I mean, for a very, very long time with proper planning.
And the time to get started is now. And so as it relates to real estate investing, this is one tool that we use. Obviously, you've got to save your money, to buy and hold real estate to create passive income. You wholesale, some of us are wholesaling real estate and using that money to buy and hold real estate. Some have IRAs, solo IRAs, or, and other things to use to invest in real estate. And so what we wanted to get across today was the power of your insurance policy to use as an investment vehicle. And so that's what I see our insurance policy. I see it as a vehicle to invest in real estate. Now, you might look at it as a vehicle to, build wealth for college funds or retirement, but ultimately that's what it really all is, because you're borrowing money from yourself for an investment, and then you're going to pay it back, and it's just going to keep compounding. And so my ask is today is that at the very least, you set up an appointment just to get either a policy review or get an illustration on what could be for yourself. As it relates to real estate investing, we've got to learn more and more. And so we're going to be bringing more and more of these type of conversations to you. Some things that, like Valerie said, this is the new thing. This has been around. It's as old as, but it's new to her. You know why? Because she's never been educated on it. And so we've got to start educating ourselves. We've got to educate ourselves on real estate investing. And so we have a coaching program. Keith, you want to tell us about, and so a lot of these talks, we talked the other night about a lot of this to our platinum coaching students.
Hey, guys, make sure that you fill out this. We want to do a good job of bringing products here in these type of forms. So if you have an idea of what you'd like to learn, fill this out and get it back to us. But we do have a coaching program. Many of you guys, quite a few students in the audience right now. But we're going to hold your hand with all the things that you typically would hear about real estate investment, flipping, holding, wholesaling. I don't want to talk products and services here, but I'm really open to meeting with you guys, free one-on-one consultation. Where are you now? Where are you trying to go? And so I will be here, and we can set an appointment, next week. But the time is now, as Greg has said. It's time for us to get going. Right now, it's the end of February. Weather-wise, it seems like it was summertime yesterday, and so we want to be able to show, by the end of the year, or maybe in a 6-month period, something for our dreams. And I would say this too, that this form here is good, but it's not. We need more, and some of us need, to be directed, to have some hand-holding going on. So, if you're interested in our Platinum Coaching Program, in the program that we have today, there's a link there. We also have Susan in the back, that if you're ready to make that jump and make that decision to join, she'll be back there to take your credit card and get you signed up. But if you have questions, give me a call or meet with me after this, and we can set a date and time.
So Phil, as we wrap this up, what advice would you give everybody?
Be open to something that is non-traditional. Right? Be open to something that you don't hear a lot about mainstream. Make sure you sit down with someone to get educated about this strategy, and at least take a look, and do it sooner rather than later, because time, will erode your ability to maximize gains and opportunities. If you think about it, way back in the 80s, way back when, individuals were stuffing money, affluent individuals, right?
Right.
Were stuffing money in life insurance
That's what they
policies
was doing, that's right.
and using them as a tax shelter because there were no maximum limits, right? Uncle Sam, government got smart about it. He said, hold on, time out. This isn't being used as life insurance anymore. This is being used now as a tax shelter. So we got to regulate this.
Right.
That's when the TAMRA and DEFRA Acts came in. And that's when the maximums were put on, yes, how much you can contribute into a life insurance policy. Because if you go a penny over what you can contribute, all your cash value becomes taxable when you pull it out. So that's why you got to make sure that you stay educated, that you review these things on an annual basis so that does not happen, right? Because this is a beautiful benefit that we have access to, right? It's a way to create substantial wealth for yourselves, your children, your grandchildren, now and in the future. Think about where tax rates are. Do you see tax rates going up in the future? Think about how much money has been spent since 2019. The government curtails taxes really two ways, right? Stop spending or tax more. Do you think they're going to stop spending anytime soon? Or do you think they're going to tax more? Right? So your methodology around taxes is also going to dictate your strategy. Right? So think about being able to utilize the tax benefits of the life insurance and understand that, which will help with the strategies on an individual basis that each one of you employ.
Is the amount that you put in?
No, go ahead.
No, is the amount that you put inside, is that tax deductible?
Is it tax deductible?
Or, like with 401ks, you can.
That's a great question, right? There are ways to make it a tax deductible contribution if you own life insurance inside of a qualified plan, but you're getting really technical at that point. Typically, you can't deduct your life insurance premiums, because if something happens, your death benefit then becomes taxable.
Yeah.
All right, you guys, any questions before we get out of here? Or any takeaways? Or did anything that we say resonate with you guys that you're gonna take away, or something that you did not know? Anybody? Give us an example.
Just throw it out there.
Tell my son to get the policy for his kids while they're young. Yeah.
Look, guys, this is the number one way to build wealth and the transfer of wealth. This is the number one way. We don't do it because there's a myth that insurance is expensive, or it's only for people who are dying. And it's really set up to build an incredible amount of wealth, because you're solely protected within that policy, and it just grows, and it just grows for you. And we just have to continue to educate ourselves. And some of you probably are thinking, I wish I would have known this 10 years ago, 20 years ago, or 30 years ago. But the time is now, you know it now. And whether it's good for you now personally, I would say have some type of insurance, because you don't want to be a burden to your loved ones when you do pass, which is inevitable. Even if you get what we call a final expense policy, get something. But my suggestion would be to get a policy, pay a little extra for it, and build cash. And then be smart about it, utilize that cash to help you build wealth. Can you do it tomorrow or next week or next month? The cash is not going to be there, but eventually it's going to grow. And then it's going to grow to the point where you are going to be able to utilize it. Don't just let it sit. Invest that money, because it's tax-free. The best investment you can make is out of that policy. And so utilize it, like I'm doing with my daughter. And you utilize that. So every year, she's going to utilize her policy to buy a property. And when she takes the money out, it's still growing. It's still growing. And so we've got to use that. And so that's one way that she's going to be able to invest every single year.
I just wanted to say, firstly, like Greg said about this policy, I had a policy as well. I got it, never heard from the agent again. The term policy, once Greg opened Big Life, I sat down with Big Life agent. It completely changed my coverage. I'm good now. I had no idea that when that term was gonna be over, the policy was gonna skyrocket.
And that's what happened to me.
I'm thankful for Greg and Big Life, because it helped me.
All right, anybody else? Michelle?
Well, I was going to say, for me, the biggest takeaway too with the new policies is that you're able to have living benefits with these policies, because I am in an insurance business. There's so many life events that I see change people's lives because they have a heart attack or they have a stroke, and people are surviving from these things. But with these policies, it doesn't have to devastate a family, because you have the insurance to be able to take care of those things.
Right.
And it's about, that's really true asset protection. In case something happened to you or in case you die, you have something to protect your family. So.
And what she's talking about, what we call the living benefits, you have a chronic illness, critical or terminal illness, guess what, you guys? Absolutely free.
Yeah.
Get the policy, comes with the policy, absolutely free. So why wouldn't you get a policy? And it's not just the policies that we're talking about, other policies, even term, come with free living benefits.
Oh, you said what's absolute free?
Huh? He woke up when I said free. He was like this. Oh, free? I was talking about the government cheese. The government cheese is free. He woke up and he heard free.
Yeah, he's talking about the living benefits that are attached to all the life insurance contracts. There's no additional charge to access those benefits, to have those additional.
And so look, you guys, and Donald says this all the time, we get sick before we die. right? We get sick. Shouldn't we have a vehicle that's gonna help us when we're sick? And especially if that vehicle is free, we should have it. And so we just have to be smart about our finances and not think that, you know, these policies are too expensive, we can't afford them. You can't afford not to have them because you are going to get sick one day and you don't want to be a burden on your family and you want to have something in place. It's to the point where I'm going to do an exchange of my daughter's policy because my daughter's policy, when I got it, didn't have the free living benefits. I want to make sure that she's going to be okay, even when I'm gone. And so I'm going to exchange her policy to another IUL. What's it called? A 1035? 1035 exchange, so that she's going to get the living benefits. So she's 25 years old, and I just want to make sure she's going to be okay. And so that's how we have to start thinking. And then another byproduct of what we're talking about is we get enough money in there. I like what Phil said, he can use it for retirement, that cash value, and it's a tax-free retirement. I like to look at it as another investment vehicle, but however you want to look at it, college fund, whatever, we start now and we build it slowly but surely. And then we get to the point where now we can use it. You can't use it. You feel like you're too old. You've got children, grandchildren, you know, talk to us. We'll show you how to set up those policies where you're over the policy, you can use it, but they're on your children or your grandchildren. And the younger, the better. And for millennials, my goodness, I mean, you could get a policy now overfunded and, you know,
Millions of dollars.
yeah.
Later on.
And you're making a whatever, $150, $200 payment for X amount of years. It's compounding. Plus you're using that money to invest in real estate too, and building up a portfolio with this money. I mean, the sky's the limit. I'm excited. You guys excited?
Yes.
Okay. Did you guys find this useful?
Yes.
And so fill out that form. Let us know if you need any more information. There's a QR code on page 3. If you just want to use our QR code for Big Life, or Stephanie make it back yet? Or you can talk to Stephanie in the back to set up an appointment. One thing I didn't mention is we use creative financing strategies to invest in real estate. And so for my daughter, she's going to pull out that money. That's not going to be enough money for her to buy a house. We're looking at a house at $200,000 acquisition. After repair value is $400,000. She's going to buy and hold that property. She's going to use a hard money lender to acquire the property. She's going to use a hard money lender to renovate the property. She needs a private lender for closing costs, down payment, and get the contractor started. She's going to be her own private lender and use the cash value. Again, she's 24, use the cash value as her own private lender. She's then going to, she's going to buy the property. She's going to renovate the property. She's going to rent that property out, Section 8. Then she's going to refinance into permanent financing. And then she's going to pay herself back. Obviously, she's going to buy the property right. So when it appraises, there's enough money to do a cash out refinance. She's going to pay herself back. You need to know who the hard money lender is. You need to know who's going to finance you on a permanent financing. And so on page 4, we use PRMG. Their information is right there. If you're interested in what I just described, and all of you guys should, give them a call or let me know. They can help you out in that same scenario. We should be using other people's money to build our wealth, but then also our own money to build our own wealth. And you guys can do that out of your insurance policy. We also do, I'm just going through the handout. We have Celebrate Settlements as our investor-friendly title company. Everything that I ever talk about, they know, wholesaling, creative financing, all those things. So they can help you settle those. All title companies aren't created equal. And so you need an investor-friendly title company. Keith talked about on page 6 our coaching program. It's $3,500. We'll give a discount. Can we give them a discount or no?
You give a discount.
All right, we'll give you a discount of 2,500. Look, you guys need to educate yourself and get coaching and mentorship. And so we have the best coaching program in the DMV, bar none. And I can sit here and proudly say that, the best coaching program. We take you out in the field. We bring you here and have classroom study every month. We have Q&As every single Tuesday. Keith does one-on-ones with you. He gives you a plaque. He gives you your own display, Coach Accountable, where you have all the resources that you need, all the forms, all the tools, contracts, marketing material, everything you need, discounted now. You can make payments. Susan, is Susan still here?
Yeah.
So we also have an investor-friendly real estate company. So if you're a real estate agent and you want to be a part of us, talk to Susan or just go to joinbrs.com. And one thing new that I'm announcing today is we're going to have an all-day boot camp. We used to have these before the pandemic, where we're going to be at the Greenbelt Marriott on April the 28th. It's a full day of learning from 8 to 4:30. We've got breakfast.
29.
What did I say?
28.
I think I said the 20, on the 29th, Saturday. So it's an all day of learning. We feed you all day, breakfast, morning snack, lunch, afternoon snack. But the most important thing is we feed you education. Hopefully I can get either Jordan or Phil here to talk more about what we've talked about. We'll have some other specialists there talking about wholesaling. I'll have some of my coaching students there, finance and marketing. He's going to do a PowerPoint on the best ways to find properties through PropStream and Deal Machine, all those kinds of things. If you're interested in our all-day boot camp, which you should be, you can either fill this form out, talk to the girls in the back. They can get you straight. We've got an early bird special up until the end of March, $225. Full day. We've discounted the price. We want to make sure that you guys get educated on all things building wealth, the insurance, how to invest out of your policies, but then also how to flip properties, how to finance, creative financing. I've got a PowerPoint ready for all the creative financing. You don't necessarily have to go to a bank. If you have bad credit, you can't get financing. I'm going to show you how you can get finance. The last thing I'll say is the market, I feel, is getting better. The market is getting better. I'm looking at deals every single day. There's wholesalers out here that are finding deals. I'm finding deals. If you have a deal that you want me to look at with you, to vet the numbers or to talk to the sellers or whatever, let me know. And, I'll help you. I was just with Carissa on Sunday. At a property in Baltimore. She's one of our platinum coaching students. I knew I was in good shape when her two children opened the door and said, "Mommy, this is nice." I said in my mind, I said, "Okay, she gonna buy this." So she's going through PRMG to get financing. So she's starting, her path to build wealth through buy and hold a property in DC. And I would suggest to you also, a lot of what we talked about with your children, start looking at that too, getting these type of policies for, how old are they?
I have one that's 18, one 10, and one 11.
Okay. And so, we want to make sure that our children are straight and protected. We want to make sure that we're protected as well, because here's what happens. I'm going to say this and then we're done. In the Jewish community, you guys, when one passes away, 2 millionaires are created, okay? Other communities, especially communities of color, when the breadwinner passes away, the wealth passes away with them. And they got to start all over. And so we've kind of educated ourselves. You guys need more, but the bottom line is you need to be protected, because you don't want to be one of those families where if you happen to pass away or your spouse passes away or another loved one, all the wealth goes with them. We want to be like the Jewish community where they they've educated themselves on the transfer of wealth, on the power of life insurance policies. And life insurance policies is not to bury you. It's not for that. Life insurance policies is to build wealth. And they allow you, government allows you, you're protected within that policy. They allow you to build wealth tax-free, borrow the money tax-free, pay the interest tax-deferred. Okay? All right, you guys, thank you so much. We've got lunch in the back. Schedule an appointment. Jordan is here if you want to do a policy review. Phil is here. Donald is in the house. At the very least, schedule an appointment to either do a policy review or to do an illustration for you personally, just to see if the numbers work. And if they don't, they can make the numbers work. And like I said, if you want to get a term policy now, no problem. At least you're protected if something happens. And you'll have the living benefits if something critically happens to you. And then you can convert up. Am I right?
Amen.
All right. All right. Thank you, guys. Appreciate your time. Okay. Okay, I'll look for your call. Okay, you have my number? It's on the handout. Okay.
Hey, man.
Okay. Okay. Good, how are you? I'm really good. Okay, all right, I appreciate it.
Those policies you like,
Okay.
you check. You know, it's different when a policy been paid out, checking account, check. You keep that, you know, because you don't miss it. All right, how you doing? So give me a call, man. I'll be looking for you. So just let me know a day ahead of time. So tomorrow I can always make
Yeah.
Okay.
All right. Yeah. Hey, Johnny. Yeah. How you doing, man?
Give me a call. It depends on the number. Depends on how much you owe. So you already paid back the hard but don't you have a loan? Oh, you already own it. Yeah, call me. Yeah, you can definitely I'll be free all week. Okay. All right. How are you? Okay. Okay. Is that, are you online? Okay. Okay. You want to sign up now or whatever you want to sign up? Are you family first life?
Yeah.
You gotta make money. How we doing, man?
Come on, man.
Angela's that's the legacy. Thank you. Piece of different things to complement everything, right?
No.
There you go. Be a little bit more diversified.
We ended a couple years ago, we talked about doing that.
Have your liquidity and your money markets.
Okay.
But you can.
Going on. It's good. You have an email? You could just go to byfs.com. Join Big Life. You can go here and just get the QR code. Join Big Life.
You're welcome. Thank you. Good. Educated.
And then, yeah, you can join us out. Or just give me my name is on the handout. That number. What do you think, man? Should we take the show on the road? Where we going next? We have more people show up than I thought. This is great. Good, you? Yeah? Sylvia, how's it going? Doing okay? Did you learn anything, Sylvia?
Knowledge is power. Unused knowledge is a wasteland. I don't say it's simple, but it's easier. Stay healthy. Yeah, so there are. There's a difference. To help you plan with the information that you have to make sure that you can stay well.
And also to
I'm trying to catch it. I'll move up the
Preoccupied with something.
I just need one.
I think you, Jordan.
Yeah.
That sound like I knew what I was talking about. Real estate man. Just enough.
Yeah, I'm the same way. So I'm the same way. I gotta write it down. Yeah, sure.
Yeah.
Good.
Really?
She's always like, what is this?
Yeah. Yep.
What's up, George?
Hi, Greg. How you doing, sir?
Get a refund. Yeah, I appreciate it. Good idea. Okay. Have you met George? Last time, right?
But yeah, man,
The training and then the joint purpose of having somebody like George with clients. Yeah, okay. There's also, that's how, when I started with life insurance, that's where I learned the most. Classroom trainings are great, right? I mean, Zoom trainings are great, all that, but I learned the most when I'm sitting there and I'm soaking it in, right? I'm actually in the game, and I'm with somebody that's been doing it at a decent level for a long time, and they're learning from that person. In addition to all the classroom training and everything else that we're always doing it.
seeing you, man.
Always
I
doing
haven't
it.
seen you in a while.
So take a supplement offer too, it's available, right? We got two. Nice to meet you too. I don't have a car, but I have. Cell phone? Okay. Sure. Yes, George. It's good to see you. Sure. All right, I like old Sue.
Take it easy. I definitely give you a call. How you doing? Jordan Clinton Wiggins, nice to meet you. So you with New York Life also? So National Life. I'm sorry. Right. And that's because the contract with y'all, y'all have a lot of stuff on there about New York.
Their appraisal came back from there. As long as the numbers work for you, in terms of the cash flow and everything, if you've got to spend $10,000 space, make sure the numbers.
Yeah, I'm looking for you guys to listen on the emails and you do finance also.
So we don't, our minimums are about 50,000. Big money. You guys have other companies that are really, the national life is necessarily your but you do those terms, therefore, sure, not just trading, but also everything else. Absolutely. So we have our information.
You guys take it easy, good to see you.
All right, man, good to see you, man. Yeah, let me know next time you go out there, we might take some up here. Okay. Eric is like, you said so your price range?
I know that's right. Good seeing you guys.
Sunday we're having
I'm going back and forth.
be out in the field.
Nice ride.
And,
That was $295 to $695.
so it's $325 if you want to do both. If you only want to do the tour, it's $125. If you only want to do the tour,
See Keith Chan?
31st.
Nice seeing you.
All right, take it easy, Jordan.
I haven't. Any information on the board. Mr. Clinton Wiggins, I gotta say hi to you.
Yeah.
So the house thing was. I gotta say hi to you.
Oh, okay. The tour? No, I mean, we're gonna actually go out, go over here, go over the mail for you. And it'll probably be real properties that you can actually buy. That's what we know. We'll go over the numbers, but we'll be out in the field to be able to ask questions on finishes, how you finish the property, just the scrap, whatever. Right. I would try to do both. Because now you're in Saturday, you're in the class, kind of like a classroom setting, at a boot camp, but then Sunday we're actually out in the field. Okay, good.
Thank you.
All right.
I texted Windows. I guess you never
Follow up with him because he said 225. Follow up with him. When I relooked at the numbers, I could probably say 210. Try to get him on the phone and
that's what I'm actually. Would it make sense?
yeah, I wouldn't want him to think we're going behind.
I tried to know
Yeah, because we're close. I mean, if he's at 220, we're at 210. I mean, I can even compromise, meet him halfway at the 215. So, yeah, don't give up on it. Okay.